50% of the level 3 CFA exam was taken up with portfolio management. And you would think after, oh gosh, I forget how many readings, but you know, close to 1,000 pages of text, if not more than that, just on that topic, there would be an easy solution to asset allocation. Unfortunately, there is a lot of art involved with asset allocation decisions. But one thing I've learned over the years is that you can still apply the standard textbook asset allocation logic as long as you are careful with it and make it much more scientific. So we're going to talk about in this section of our seminar how you can scientifically allocate a portfolio, specifically using SEM's new dynamic portfolios, mixing them in with some other assets. Before we get there though, just let me kind of take a detour here and explain why we're doing what we're doing. For the last 18 years, we've seen this investor behavior cycle repeat over and over again. It is beyond frustrating for me to see clients constantly falling for these emotional traps. Probably one of the most exciting things about our new dynamic portfolios is they help overcome many of these emotions. In my opinion, the portfolios we've put together, which is a mixture of tactical and dynamic options, should give clients something that is working throughout all the various stages of the market cycle. Therefore, if you see the market running up and things are doing great, dynamic aggressive should also be participating. That's the design behind it, is that consistent exposure to the market. And then we believe with our asset allocation algorithm, by following the economic cycle, we should actually outperform a normal buy and hold aggressive portfolio. And then coming back down, the mixture of tactical in there gives them something that provides a defensive lineup, a defense to their portfolio. And then obviously back up, it's not going to be perfect. And I know our portfolios won't be perfect. We're still going to see clients that aren't making enough money. They're going to be frustrated that their defensive portion is doing that. But you can't save all clients. You can't prevent them from themselves. But I believe our new offering really helps prevent clients from falling for this. As I said, I plan on being here another 30 years. This is the third time that we've gone through this. So once every 6 years, I'd rather not go through this 5 more times. One quote I think, when I did the CFA studies that I really found interesting is, I thought when I went into it, they were going to try to talk me into traditional or that strategic asset allocation. And granted, level 1 especially talked about the modern portfolio theory, why active management doesn't work. It kind of drilled in the academic thoughts. But then as you started moving to level 2, they started talking about ways that a portfolio manager could add value. And then level 3 was basically saying, here's why traditional management doesn't work. And one of the quotes I took from the book from the CFA Institute says, a practical integration of behavioral and traditional finance may lead to a better outcome than either approach used in isolation. And that's really the root of what we're trying to do here with our dynamic portfolios, is taking that behavioral finance and applying it to traditional finance and give them portfolios that, in our opinion, are good enough. So we mentioned earlier in part 1 the reliance on correlations when traditional portfolios are put together. They expect these correlations to remain stable even during those market shocks, and they expect investors that are in those portfolios to remain rational. But the third issue I've always had with modern portfolio theory is how sensitive it is to the study period. Now let's walk through an example. I ran an optimization for all the strategic asset portfolios to find the very best set of allocations. This is also known as the efficient frontier. That's represented by the dashed purple line on the chart. I also plotted some portfolios I put together using our own algorithms that are not sensitive to the time period, but rather look to provide true diversification by including non-correlated, engineered trading systems, rather than using those as individual asset classes. Again, we talked about that in part 1, how we use our programs as the asset classes in our portfolios. If we use only the last 5 years, we can see how the 100% passive or strategic portfolios appear to be the best solution. Sadly, I find too many clients, and even more sad, their advisors, using the 3 or 5 year time horizon returns to evaluate their investments without understanding this is a bull market period. So they better hope that the next 3 to 5 years are going to be the same as the last. For somebody that believes the next 5 years will be a bull market, it's really tough to argue against a 100% passive portfolio. Except if you notice that SEM Dynamic Aggressive Growth Portfolio, or DAG, it basically has the same returns as the S&P 500 with about 20% less risk, even over this 5-year period. That's where the alpha, the real advantage, comes in. And that's why we wanted to get DAG into our lineup, is this is your bull market portfolio. But what happens to our efficient frontier if we study the next 10 years? The last 10 years. And that's what we see here. Now we really start to see the disadvantages of the traditional method of portfolio construction, as well as how sensitive the efficient frontier can be to the sequence of returns. Remember, in the last slide, we looked at the 5-year time horizon, which was all a bull market. The 10-year time horizon is what I would really consider at this time a normal market environment. You get a bull market, followed by a bear market, followed by another bull market. And the duration of those is about the same as average. So at this point, I like to use the 10-year time horizon. We'll talk about how you pick your time horizon in your optimization here in a minute. But note how much better the Dynamic Aggressive Growth portfolio has done relative to the S&P 500 or even the Morningstar Aggressive portfolio. In addition, what I really like is if you combine DAG with our other more tactical portfolios, you would have had a vastly superior result than that efficient, or so they like to say, buy and hold portfolio. For longer term investors that can ignore some of the market fluctuations, these 10-year optimizations are probably the ones I would recommend, as that is what we are likely to see over very long periods of time. However, we do have many people, myself included, that fears we may be at the very beginning of a bear market, or at least the latter stages of this bull market. You look at some of the structural issues and some of the things that have happened, and I could really see a much more difficult time ahead, even just looking at where valuations are from today's starting point. So let's extend our study out to 15 years to see what a portfolio would look like if that sequence of returns goes bear market, bull market, bear market, bull market. Now, if we start with a bear market in the very near future, we can really see the value of a 100% tactical solution. That's those orange and blue dots or squares on the chart there. Notice now DAG is now down along the passive efficient frontier. It has returned significantly higher than the S&P 500 and less risk, but that's important to understand that DAG will lose money and it will be risky if we're going right into a bear market. Now, the returns are about the same as the Morningstar Aggressive portfolio, which is its benchmark. And again, it shows less risk. So it's doing its job. Remember, this is your long-term, consistent exposure to the market with some alpha. And all the results still continue to point to that. Now, I had an advisor at a conference ask me if I could put an override on our asset allocation decision for DAG. My answer was pretty simple. I said, yes. It's called Enhanced Growth Allocator, or EGA. We do not have the benefit of hindsight when we make our asset allocation decisions. And we have to, we've yet to develop a model that can give us a reliable enough signal to know ahead of time what the market environment will be in the future. Remember, the purpose of DAG is to give clients consistent exposure to the market with more alpha than a buy and hold portfolio. If we were to add some sort of filter where we subjectively, or even if we tried to mechanically put on that filter, we simply would lose that consistent market exposure. Which brings us to EGA. Yes, it's had a difficult 18 to now about 24-month period. However, the purpose of EGA is to provide a longer-term growth option with less downside exposure. EGA does have the ability to go all the way to cash and offers a much more defensive option than DAG. Of course, that defenses cost EGA, especially when we get into a narrow market that we've seen over the last 18 months. When we look at the future, we've been calling the dynamic encore portfolio combinations the good enough portfolios. We call them this because, yes, we could get even higher returns by being 100% tactical at the exact perfect time. But if we were wrong, we end up missing out on too much of the upside. Then we see what's already beginning to happen with our clients. FOMO, remember that's called the fear of missing out, really kicks in with clients, and they began to abandon risk management in favor of higher returns. Now notice there how the dynamic encores have all plotted over the various market environments. They were getting close to the buy and hold portfolios over a bull market only period, well above both 100% passive and 100% tactical portfolios if the sequence goes bull, bear, bull, and right in between if we go bear, bull, bear, bull. Now these encores include the consistent exposure to the market via DAG, giving clients something that is participating during the bull markets, but lower risk by including some tactical exposure that should be highly attractive during bear markets. They say you can't have your cake and eat it too, but in this case, we think that saying might be wrong. Now let's take a little break and we'll be back for part 4 to discuss how to scientifically allocate a client's portfolio.